Okay, so in this episode, I'm going to talk about P&L ratios and why they're a really quick shorthand way for you to be able to pick up your financials and understand what matters within your business. Hello and welcome to the Profit and Cashflow Mastery Podcast. I'm your host, Gavin Smith from The Profit Analyst, and in this podcast, I'm going to be showing you how simple, easy, and more important, how practical numbers can actually be for you as a small business owner. I have a pretty extensive finance career and background, but more importantly and more relevant to you is I'm a small business owner myself. I've built multiple businesses from startups and turnarounds through to 7 and even 8-figure plus businesses. And what I've learned along that journey is how to make numbers really simple and easy and practical and how to use them to guide you in your business strategies. And ultimately, that's what I now love doing. I love teaching other business owners how to make the numbers simple and easy so they can gain real clarity about their numbers. I love showing them how to identify what numbers actually matter in your business, but more importantly, I show you how to use your numbers so that you can make better decisions, which ultimately leads to better profitability, better cash flow, and growing and scaling businesses. So let's dive into it. So first of all, what is a P&L ratio? It's basically taking one of the cost categories and dividing it by the income so you can see how much of a business's income is being spent on a specific area within your business. So just a reminder, I take all the expenses in your business and just categorize them into 5 key numbers: the cost of sales, the team, the marketing, the overheads, and the property. So already we're dealing with just 5 simplified numbers when it comes to looking at the expenses. But what's a really important number or a really simple way to track those numbers over time is to understand the ratio. That is, what percentage of the business is going into that category. I have a little analogy here that I like to use for people to be able to understand what's important when it comes to the P&L ratios. And that is, imagine your business as a pizza. And you might have a little business, in which case you probably get a little pizza, or you have a really big business, in which case you have a really big pizza. The thing about ratios, it doesn't matter how big your business is because the ratios are just the proportion of your business being spent on this category. So then what we want to do, I want to give you a pizza wheel, a slicer, and you're going to slice your pizza into 6 categories. Now what those categories represent, 5 of the slices are these 5 different costs within the business. So the COGS, the team, marketing, overheads, and rent. And the 6th slice is what's left over. And that's your profit. That's your piece of the pizza. And so this is a really great way to be able to see what matters in your business. So let's say we're looking at your business and you're like a house building type business. Typically in that world, the cost of sales can be anywhere from 60 to 80% of the business. So take your pizza wheel and slice your pizza and slice off one slice of the pizza, which is like 80% of the pizza, and go give that to all of your suppliers. You go give that to Bunnings and the plumbers and the tradies and everything that you're using on that job. The rest of the pizza gets sliced into these little slithers that go for your team, your overheads, your marketing activities, and what's left over might be your little tiny pizza wedge for yourself. In a different business, let's say you're a service-based business. In this case, the team is going to be the biggest number for sure. And so you might have a really small proportion, which is cost of sales, the direct things you're buying for the product. But then the biggest slice, let's say you're like a legal office or a marketing firm or something, your wages are probably going to be at least 50, maybe even 60%. And in that case, again, you're basically slicing off half the pizza and giving that to the team. And then you're slicing away a portion for the landlord, a portion for all the overheads, a portion goes to marketing. And again, what's left over is your piece of the pizza. And so when you think about your profit margin in a business, is it single digits? Is it 5, 6, 7%? Are you making double digits like 10 or 20? And you can think about that in terms of the context of how big a slice of the pizza are you getting? And if you want to increase your slice of the pizza, you need to be obviously able to make the rest of the pizza's slices smaller. So this is the way of thinking about ratios that helps give you an idea about what matters in your business. Because obviously, if you want to focus on where you can get the quickest win, you want to focus on the area which has the biggest slice, because that's where proportionally you're going to be able to make the biggest difference straight away to be able to make that piece a little bit smaller. And every percentage you can take off that piece is going to fall into your profit piece, the leftover piece. That's yours. I love this little pizza analogy as a way to be able to understand ratios within your business. The thing I love about ratios, once you learn how to read ratios within your business and know what they represent, and again, it's not complicated math here. It's the total money you're spending on that category divided by the total income. So it tells you the portion of it. Do a simple example. Let's say you spend $40,000 on wages every month and your business is doing $100,000 worth of sales. 40 divided by 100 is 40%. Your wage ratio is 40%. Now, why ratios are great is because typical in a business, there's fluctuations, right? Some months are high, some are low. You might have seasonality. Your business might be growing over time. The good thing about ratios is they're always add up to 100, assuming you're making a profit. They'll add up to more than 100 if you're making a loss, unfortunately. It doesn't matter whether your business is just starting out, doing 10K months, 50K months, something like that, or if you're doing $100,000 months or $1 million months, the ratios are always the same. And so being able to track your ratios over time is telling you how efficient you're being at your cost of sales, how efficient you're being at your team, how efficient you're being at making a profit margin as the business grows and scales. It also helps you when you know what the industry averages are for your business to be able to easily benchmark your business compared to industry averages. I've seen some of that. For example, in hospitality, many people aim for 30% for their cost of sales. Now, I know from all the hospitality businesses I look at, not many are actually making it. They'll have P&L ratios of 39% or 35% when it comes to their cost of sales. But this is great because it helps show us where there's opportunities to improve their business. And just because the average is 30 doesn't mean you need to aim for that. You can aim for 25%. And so P&L ratios help you not only to be able to benchmark and compare your business to other businesses, but it helps you to benchmark your own business over time. Compare this month to last month or this year to last year and see, am I getting better, more efficient at the way I'm using the costs within my business? So there you have it. Just a quick episode on how and why P&L ratios are important and how to use them in your business. Thanks for tuning in to this episode of Profit and Cash Flow Mastery. If this episode helped you gain clarity with your numbers, then please make sure you give us a 5-star review wherever you're listening to this. Don't forget to subscribe to our podcast. And if you want to stay connected, make sure you give us a follow on the socials at The Profit Analyst.